Ladies and gentlemen, good day and welcome to Expleo Solutions Limited Q4 FY24 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Asha Gupta from EY Investor Relations. Thank you, and over to you, Ms. Gupta.
Thank you, Nirav. Good afternoon to all participants in the call. Welcome to the Q4 FY24 earnings call of Expleo Solutions Limited. The results and press release have already been mailed to you, and you can also see the same on the company's website. In case anyone does not have the copy of press release and presentation, please do write to us and we will be happy to share with you. Representing the management today, we have Mr. Balaji Vishwanathan, Managing Director and CEO, Mr. Periyakarupan Paliyappan, CFO, whom we will be referring to as Mani. Balaji will start the call with a brief overview of the quarter and year gone by, which will be then followed by Mani, who will be giving you a brief update about the financials. After that, we will open the floor for Q&A session. As usual, I would like to remind you that anything that is mentioned in this call, which gives any outlook for the future or which can be construed as forward-looking statement, must be viewed in conjunction with the risks and uncertainties that we face. This risk and uncertainties are included but not limited to what we have mentioned in the prospectus filed with the SEBI and subsequent annual report, which you can find it on our website. Having said that, I will now hand over the call to Mr. Balaji. Over to you, Balaji.
Sure. Thanks, Asha. Thanks, Nirav. Thank you for the investors and analysts who have joined the call. For the quarter ended 31st of March, we have seen a marginal growth. Primarily, we had, if you recollect, the last quarter we had a one-time benefit. If you were to net off with that, we had a very marginal growth of around 3.6, 3.7%. And excluding that, we had growth of around 2.6%. The core markets are still showing weakness in terms of pipeline and demand, while some of the markets like Middle East and India are actually showing, better pipeline and more opportunities, but the size of the opportunities obviously is relatively smaller. One of the challenges has been around expectation of demand based on which we had built a certain amount of bench from Q2 or calendar Q2 of 2023 onwards. Unfortunately, some of those opportunities did not really materialize. So we had a higher bench or the higher number of people than what we required when we started the calendar year. We've been acting on optimizing our bench and the talent pool based on what our demand is. And that action started from end of February 2024. While part of the actions are actually will show in this quarter, that is in Q1 of this financial year. But most of the actions will actually start showing from Q2 onwards, which will actually help us in getting to the target EBITDA margins of 16 to 18%, which is what we have been talking about for the last year and a half to 2 years or so. Overall, we have been investing in AI and digital technologies, which is what is showing the growth opportunities as well. And we have been investing on both in terms of training and upskilling our team, and also in terms of inducting some of the leadership from these domains. And over the last 6 months, most of our growth opportunities have been primarily in this, and that's what you would actually show in our digital share of the business as well. We have had not much traction with some of our smaller customers. That's why you'll probably see a slight decline with some of the smaller customers, but we have actually signed record number of new customers where the opportunity sizes have been relatively small, which we hope that as the demand picks up, during the course of the next 2 quarters, we will see more number of customers.
Sorry to interrupt you. Sir, may I request you to speak a little louder, please?
Is it better now?
Yes, thank you.
Yeah. As we go through the next couple of quarters, we will actually see more number of those customers moving beyond the 500,000, getting closer to the million and million plus customer range. That's basically what I have as a summary. Would like Mani to provide more information about the financials. Mani, over to you.
Sure. Thanks, Balaji. So I'll talk about the financial results for the quarter compared to the previous quarter. So it's a quarter-on-quarter comparison. So the operating revenue was at 2,554 million compared to 2,502 million in the last quarter. It's an increase of about 2.1%. Our overall total income was 2,572 million. It's down by 1.6% compared to the previous quarter of 2,615 million. When it comes to profit, our EBITDA was at 398 million, which is 15.6%, compared to 385 million, which is 15.4% in the last quarter. Profit after tax was at 148 million, which is 5.7%, compared to 338 million, which is 12.9% in the previous quarter. EPS stood at 10.12 rupees in this quarter, compared to 21.93 rupees in the previous quarter. Overall cash position, we were at 1,840 million net cash in this quarter, compared to 2,117 million in the previous quarter. I'll move on to the year-on-year comparison. Operating revenue, as I said, this quarter was at 2,554 million, compared to 2,311 million in the same quarter last year. So this is an increase of about 10.5% year-on-year. Total income is at 2,572 million this quarter, compared to 2,349 million same quarter last year. This is an increase of 9.5%. On profits, EBITDA, we were at 398 million this quarter, compared to 431 million in the comparable quarter last year. As a percentage, this is 15.6% versus 18.7% same period last year. On PAT, profit after tax, we were at 148 million this quarter, compared to 290 million in the same quarter last year, which is 5.7% versus 12.3% comparable period. On EPS, we were at 10.12 rupees this quarter versus 18.73 in the same period last year. On cash, we were at 1,840 million this quarter, compared to 1,557 million same period last year. I'll talk about the full year comparison. On a full year basis, full year ended March 24, we were at 9,649 million on revenue, on operational revenue, compared to 9,033 million in the previous year, with a growth of about 6.8% on full year-on-year basis. Total overall income, we were at 9,724 million compared to 9,194 million in the last year. This is a growth of about 5.8%. On profits, EBITDA, we were at 1,483 million, which is 15.4% this year, compared to 2,001 million, which is 22.2% in the last year. Profit after tax, we were at 887 million this year, which is 9.1%, compared to 1,357 million, which is 14.8% in the last year. EPS, we are at 58.27 rupees this year, compared to 86.27 rupees in the last year. On net cash position, we were at 1,840 million this year, compared to 1,557 million in the year ended March 23. That's the overall highlight on the numbers. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Rohit from iThought PMS. Please go ahead.
Hello.
Go ahead, sir.
Yeah. Hi. Hi, Balaji. Hi, Mani. So, Balaji, just wanted to understand, for this quarter, our margins were about 13%, and you attributed that there was a bench, etc. So how do you look at the coming year, FY25? So if you can just maybe give your overall views on what kind of growth and how should we think about margins for this year? Hello? Hello?
Sorry, I
Hello?
believe you're on mute.
Sorry, can you hear me?
Yes, sir. Now we can.
Yeah, sorry about that. So from an overall growth perspective, we are, as you could see, we've done around 3% organically, in this quarter, and we expect that will probably be similar growth percentages over the next 3 quarters as well, which would basically make it closer to the double-digit growth is what we are expecting for the year. Having said that, of course, each quarter comes with its own challenges, depending upon how the core markets react, particularly UK, Germany, and France, from where most of our businesses actually come from. From a margin perspective, our EBITDA should be in a similar range as what we are at right now, which should be in the range of. Right now, we are at 15.6, but we expect that we should be in the range of 16 to 17 over the next 3 quarters as we start reducing our bench and our utilization rates going forward. Mani, you want to add anything more?
Yeah, I think you covered most of it, Balaji. Yeah, so, we are looking at similar growth rates, and our profitability should be in the range of 16 to 17% for the next 3 quarters.
Got it. So just 2 more questions on this. So one is, our longer term goal in terms of CY25 goal was obviously a much higher goal, which in terms of workforce. And at the same time, I think which we sort of deferred. So, we had that 10,000 odd workforce goal. And at the same time, at the time of the merger, we had this plan of increasing our outsourcing and offshoring to the Indian offices. So in that context, how does that strategy play out? Because you're still sort of guiding for only 10-11% kind of growth for this year. So how should one look at it? Maybe not this year, but like longer term, maybe 2 years out. How does one look at the overall business from here on? Because I understand we had some one-off last year, but even adjusting for the base, between 2-3 years of sort of flattish kind of growth, 2 years of flat kind of growth, at least on the profitability side. So just want to get how should one think about the business, let's say 2 years out from here? In the context of the larger target and in terms of workforce, and also the greater outsourcing that or offshoring that was supposed to happen at the group level, which should benefit Indian companies, Indian subsidiaries which are listed now. Yeah.
So because of the softness in the European market, the growth, whether it is from the group, also has been relatively lower. Having said that, the group contribution to our revenue growth is higher than what we have been able to do directly from the other markets as well. And from a profitability perspective, I think we had a setback in the last 2-3 quarters because of some softness in demand and some of the one-time benefit which actually gave us a bigger push last year. But organically, our expectation is that we will be in the 16 to 18% range, which is what we talked about earlier as well. And I don't see that changing significantly from where we are right now, because we had a significant amount of cost because of some of the headcounts that we had in the last 2 quarters, which we have started acting on, and that's why we are slowly inching towards the 16.5%, 17%, which is what we would expect over the next couple of quarters, and we should be in the 16 to 18% range. And in terms of headcount growth, the headcount growth was not just organic, but it was supposed to be a combination of both organic and inorganic. Given the current situation, the inorganic component has not kicked in at all. And, hopefully sometime next year when the markets become better and we are able to get a little more access to, cheaper funds, there is also an expectation that we will, the group will do some acquisitions and which will actually help us in growing the headcount numbers in India as well. But of course, these are all expectations right now. Nothing concrete at this particular point of time.
Got it. And we are opening a few branches and sort of opening new offices. In the context of this subdued demand, how should one see it? And then finally, Balaji, cash balance is also getting accelerated, and we were initially waiting for the merger to happen. That's also done now. You've talked about inorganic also, but any sense on if you can articulate the broader capital allocation strategy, how would you want to distribute the cash or use the cash rather? Sorry. So if you can maybe talk about that.
So the offices that we opened, which is actually expanding our capacity in Chennai and Bangalore, is primarily in anticipation of some of these demand and also expecting people to come back to work, because that is one of the important elements for us to have a more cohesive team and also whom we will be able to upskill a lot more easier rather than having everybody working remote. So right now we have the capacity that we have added both in Chennai and Bangalore will give us a little more headroom than what our current demands are. And we are looking at opportunities to expand even beyond this, provided we have a more clearer outlook on demand and where it's going to come from. But we are still optimistic that we should be able to add more facilities, because the outlook from 2025 onwards at this particular point of time looks, even though not firmed up, but it certainly looks better. We expect that once the core market starts opening up and they are able to, because the inflation and other elements are actually stabilized in most of these markets, particularly UK, Germany, and France. Once we start seeing some growth, we should be able to grow faster in India from those markets as well. And on capital allocation, we are still, similar to what we talked about earlier, we are still thinking that we will be able to decide on something which will, some inorganic opportunity even within India, even though small because of our cash component, which will help us in adding better capability and which will help us attract more business from the group as well. If we are not able to find anything, over the next 2 quarters, then we will decide on, how do we allocate the cash accumulated.
And so actually that's helpful, Balaji. The office, his question was not necessarily about Chennai and Bangalore, but we are also opening overseas offices. So
the overseas office in Dubai is actually, we are closing down our pre-zone entity in Dubai and opening an on-site office in Dubai, primarily because the government regulations have changed there, which allows foreign entities to operate from mainland, which is to cater to the local business within Dubai. So till now, we were actually having a local contractor or local human resource company which was actually providing us the visas. We don't need that anymore because of this change in rule, and that's the reason why we have opened a new office in Dubai.
Got it. Okay. I'll join back in the queue. I have a few more questions. I'll join back.
Sure. Thanks, sir.
Thank you. Participants, you may press star and one to ask a question. Next question is from the line of Mihir Manohar from Carnelian Asset Management. Please go ahead.
Yeah, hi. Thanks for giving the opportunity. Sir, I wanted to understand, do we have testing as a service in our verticals? Just wanted to get an understanding. Do we have testing as a service offering?
Yeah, that is the biggest component here, because we started off as a testing company. While we have actually branched out beyond testing, testing is still our bread and butter. The only thing is that earlier we used to have a significant amount of manual testing or functional testing element. Now that particular component has actually increased more in the automation space, automated testing space and DevOps rather than the functional testing element.
Sure. So what would be testing revenue for us in this financial year, FY24?
So the way the business is split, here is that we have 30% of the business which comes from engineering and 70% of the business which comes from technology services is what we call it as. Out of the 70% on the technology services, close to around 45% also is from the quality assurance or what we call it as the software testing space. And the remaining is automated testing, performance testing, security testing, multiple other elements including DevOps, software development and other things.
Sure, understood. So 45% of the company, right?
No, 45% of the 70%. So it's approximately 30, one third.
Understood. Sure. Sir, how do you see this particular pie of the piece in this specifically generative era, Gen AI era? There are talks that the manual testing and the part of the piece will get substantially impacted. So your take on this will be quite helpful.
Yeah, it is going to get impacted, and that's the reason why we are gearing up with our own investments in AI as well. And we have a couple of POCs and tools that we have created based on Gen AI and what we call it as predictive quality assurance and risk-based quality assurance as well, which will primarily drive more of automated testing and the test engineering part. And that's the direction in which we are going as well. So 10 years back, probably quality assurance was 90% of the business.
Sure, understood. That's helpful. My second question was on the engineering outsourcing. We were looking at the engineering overall outsourcing which was there from the group, after the corporate restructuring which happened, to take it from 5% to 20-25%. Can you just mention, what is the current status on this, and to what level of penetration have we reached for the engineering outsourcing, and what more kind of scope can be there? If you could quantify that would be really helpful.
So engineering, like what I mentioned, is approximately one third of the total business that we do at this particular point of time. And the group business that we do is approximately 33 to 34%. If I compare it with what it was when the merger happened, the group business was approximately 27% of the total business, 25 to 27% of the total business. Right now it's close to 34% of the total business. And that is the pie which is growing, and that pie is primarily from the engineering services.
Sure, understood. And just last question on margins, and you mentioned about 16 to 70% over the next 3 quarters. Should we see 16% reverting back immediately in the first quarter itself?
Yeah, we are at 15.6, and I think we should be able to get to 16%.
Sure, yeah. That's it from my side. Thank you.
Thank you very much. Next question is from the line of Faisal Hawa from H.G. Hawa & Company. Please go ahead.
So, sir, we always say that the outlook for IT services is still not very clear to us. But why are we not attempting to get more work out of our parent itself? And I appreciate that we have increased our share with them also by around 7 to 8%. But the easiest way could be to get work from them and get a lot of outsourcing done.
Yes, Mr. Awad. So, that's what we have been trying to drive as well. If you recollect, what we said is that, by 2025, we should ideally have 45% of the business coming from the group and 55% of the business coming through our direct markets. The challenge with the core markets, which I said, which is primarily UK and Europe, continues for the group as well. So, whatever challenges that we are facing, they also have the same challenge. And what the outsourcing which the group does is primarily the new business that they are trying to acquire rather than the existing ones, because it's not easy to ramp down the existing headcount, in Europe and start building the headcount here. It's only for the new businesses that the group is winning where we have a significant portion of the business which comes to India. And if there is a challenge with getting new businesses, then obviously it will have an impact here as well. The group is trying to do everything possible, and that's the reason why the share from the group business is continuously increasing.
But in most conversations with, on LinkedIn, etc., Expleo Global is always saying that, they are growing at 20-25%, and they have almost, I think, if I'm correctly informed, they have reached like $1.7 billion revenue, 1.7 euro revenue. So, I mean, at the very least, we should be growing, commensurate to that, and, we should enjoy better margins also, because that involves zero marketing cost.
Not really. I'm not sure where you saw the 1.7 billion euros. The last year we closed at around 1.49, and currently we are at little over 1. But the expectation is that we will probably be in the range of around 1.5 to 1.6 this year. We have not touched 1.7 yet, and the group is growing at anywhere between
0.15 billion. But this same entity used to be 1 billion around 1.5 to 2 years back. So,
no, it was actually so when the Assistant and SQS acquisition happened, we were at close to around 1.1 billion, and when the COVID hit, the revenue went below 1 billion, and then in 2021 we crossed the 1 billion mark again. Last year we closed at around 1.2 billion, and then we this year we closed at around 1.4 billion, and the expectation is that we'll close anywhere between 1.6 billion, 1.55 to 1.6 billion this year is what our expectation. We'll be growing at an average of around 12 to 14% at the group level, and the group is actually currently at an EBITDA percentage of little less than 9%, and the expectation is the group also will be at around 10% this year.
So, when we pitch for new business, why are we losing out? Which vertical or which capability is absent in our company due to which we lose out on business?
So losing out on business is primarily, if I were to look at from a capability perspective, we only pitch for where we have the capability rather than trying and that's why I'm saying that no, we are trying to invest in terms of even the smaller acquisitions that we are doing, is in terms of what capability we don't have, which we can actually pitch. And on losing out, either it's because of the price or it's because of some of the size of the engagements, because the customers look for larger companies as there are larger engagements as well. We are not losing out primarily because of capability, because we only choose the areas where we have capability, and it's only in smaller engagements where we try and do the experiments, because that's where the customer also will be okay with experimenting or trying out with somebody new.
So the most recent acquisition that we made around 1.5 years back, what is the revenue of that company now?
When we made the acquisition, they were at around $3.5 million. Last year, we closed at a little over $5 million from that sector.
But they are helping us with the capabilities at least.
That's right. Yeah.
Okay. I appreciate your answering my questions so well, sir. Thank you.
Thank you very much. Participants, you may press star and 1 to ask the question. Ladies and gentlemen, you may press star and 1 to ask the question. Next question is from the line of Jagdishwar from Japa Investments. Please go ahead.
Good afternoon, sir. Am I audible?
Yes.
So this is regarding the receivables day, if I see the slide, the receivables day is showing at 104, and I presume it is based on standalone numbers. But if I take the consolidated number, receivables days are quite less. So why is it that we are showing our receivables day on standalone number and why not on consolidated number? This is my first question.
Okay, I'll
Any more
take
answer?
this question. Yeah,
Yes.
I'll take this question. Jagdish, this number is actually a consolidated financial number. I'm not sure, that you are saying this is standalone. So 104 days is basically our consolidated. Sorry?
I guess 950 crore is the top line. And if you divide, let's say 250 divided by 950, it is coming at 94 days. Standalone receivables are much higher than consolidated receivables.
You are only looking at, I think, accounts receivable, right? I think this DSO includes unbilled as well. So
how do you calculate? If you can explain, I mean, my calculation was showing that I was using all the consolidated numbers and getting the receivables days of 94. And your presentation says 104 days of receivables. So your calculation methodology you can explain.
Sure. I can probably provide that explanation separately, but what I would like to confirm on this all is on the consolidated financials. And the reason why the DSO has gone up compared to the previous quarter is because one of the collection from our group has been a little lower in this quarter, and also from one of our key clients, it's low in this quarter, and we have been able to collect from both our group as well as from this key client, and our cash balance has substantially improved in the month of April, and our DSO has gone down from 104 to 98 days.
Okay, I see. No, it has gone down or YOY, so your basis of calculation is consolidated balance sheet, receivables end of the year receivables divided by total revenue for that particular year. That's right, is it?
That's right. Receivables.
You don't adjust anything other than that.
Yeah, correct. It is receivables including unbilled. It's the sum of the two divided by 7.
Okay. That is your own internal figure.
That's right. Yeah.
Oh, I see. Okay, and second question is, we have missed dividend again this year. Last year we gave some dividend. And given the size of the acquisition proposed or planned or thought out, isn't it prudent to maintain some kind of dividend payout policy to ensure stability in signaling shareholder interest? Because this financial year went by. We closed. It is a reasonable number given the tough environment, and we are still sitting on a sizable cash. So Balaji can explain your thoughts on this.
Yeah, sure. So, there was a similar question from Rohit as well when we started the call. So, what we are doing is that we are looking at, what kind of acquisition that we can do locally here in India while the group is having its own plans. And we are looking at what we will be able to do during this quarter. And if we are not able to close anything during this particular quarter, then we will go back to the board and ask for suggestions on how we can do the capital allocation and cash allocation. So the plan is to see if there is anything that we can do as an acquisition which will be more accretive for everybody. And if we are not able to do it, then we will relook at what we need to do from a dividend perspective.
Thank you so much, and all the best.
Thank you.
Thank you. Next question is from the line of Kunal Shah from Enam Investment Managers. Please go ahead.
Hi, thank you for the opportunity. So my first question is on the rationalization that we're looking at in the headcount. Is there a number in mind where you want this to settle?
Yeah, so it will be based on what we have the demand for. So right now, I think most of the action has been already taken. We are not expecting any big changes. But what you would know, typically it takes 3 months for the headcount to actually exit from the system, and that's the reason why there are some numbers that are already there in the system as well. So we don't expect the build headcount, to reduce significantly from here at this particular point of time. And currently we were running at approximately, in the mid-teens in terms of our bench percentages, which we are looking at trying and getting it to 10% or so, which should happen during the course of this quarter.
Perfect. And second question is on line of, the business that we are generating on our own. So, the parent business is growing well. What are the steps we are taking, to grow our business faster? Because, we're still a small company, and at this stage, our growth can be much faster because we have a lot of good tech on our books or in our capabilities which we have. So, what are the steps we are taking to, utilize that better?
So, even though the group is not big in the US or not focusing on the US, we did the investment around a year and a half back of buying a data management and data quality company in the US. And that particular business is growing quite fast, and it's growing at almost 40 to 50% year on year. And the other markets like Middle East and India, of course, we all know, the profitability is a challenge. So we are focusing on where we will be able to do a balance between both profitability and the growth. So both the India market and the Middle East.
The person you are speaking with has put your call on hold.
Participants, please stay connected.
Some other incoming call, which I had to disconnect. So we are looking at what is it that we can do in growing both Middle East and the India market.
Okay. But so in terms of, I see the revenue mix, we still get 50% of our revenue.
Yeah, sorry, go ahead.
50, yeah, sorry. So we get 50% of our revenue approximately from Europe, which is a key market for us, despite if you take out the group business as well. So how can we grow that business? Middle East and India, I understand, but Europe, it is a very competitive market. There are a lot of Indian companies, IT service companies are present there. How do you plan to grow that business, part of the business?
So that's what we are trying to focus through the group, from specific domains, particularly in the technology and digital space. India is the most preferred location for the group to outsource as well from Europe. So as the demand goes up in Europe, we will get more business from the group. And like somebody else also mentioned, one of the other gentlemen mentioned, the opportunity to grow through the group basically would mean that, our margins are more or less secured because it's on a cost-plus model, and we really don't incur too much on a sales expenses.
Right. Okay. And this subsidiary that you're opening in Thailand, what is the idea behind that?
It's for one particular customer who's actually from whom we are trying to engage in this particular market. They want to grow that particular geography, and there is an opportunity to add some 40-50 headcount during the course of this year if we are able to do it. Of course, it's not finalized as yet, but we just wanted the board to approve setting up that office. We will open the office once we are clear about the opportunity, and it's only an in-principle approval that we have taken.
Okay. And in terms of our business development team, of the own business, not the group business, what will be the strength like and how that has changed over the last 4-5 years?
So, when I joined 6 years back, we had around 6 people who were doing business development. Right now, we have 14 of them between India, Middle East, and in the Southeast Asia market. We also hired a sales manager in US as well. That was around end of last year. So we are around 14 people right now. And we also have another close to around 18-20 people who are part of pre-sales who are also focused on each of these jobs.
Got it. Great. Thank you so much. Thank you.
Thanks.
Thank you. Next question is from the line of Priyankar Sarkar from Square 64 Capital Advisors. Please go ahead.
Hello. Hope I'm audible.
Yes, sir. Yeah.
Yeah. Sir, one quick question, clarification rather. Sir, if you can split how much we get from the group for engineering as well as for the technology segment.
Mani, would you have that number handy straight away?
We don't have it handy, but I think I can get it if I can get a few minutes.
I can probably try and give you a rough order of magnitude.
Sure.
Approximately 34 to 35 million is what we did with the group, out of which around 11 to 12 million is from the technology business, and the remaining close to around 21 to 22 million is from the engineering.
11 to 12 million is from tech and the rest is from engineering.
From engineering, yeah.
Okay, and so this segment, only talking from the group, this segment is going fastest engineering, right?
Engineering, yes.
Got it. And sir, in terms of competition in the engineering space, who would be our competitor?
It depends on sector. So if you were to take the automotive sector, it's primarily people like KPIT and Alton, Altron, which is part of Capgemini now. And if you take the avionics or the aero sector, it's primarily the OEM, so they have their own captive centers here. Whether it's Boeing or Airbus or Dassault, all of them have their own centers here. And apart from that, Capgemini, Alton, from a digital perspective, also companies like Access Cadus and Accord and others are also competition for us in the aerostructures and the avionics.
Got it. And sir, auto, so in this engineering space, which is approximately 33% of our business, that one third rather, so that, how would the split be in terms of auto and some of the other major segments?
So it's almost 50% is aero and approximately 40% is auto, and another 8-10% is other manufacturing industries.
So 40% is auto and 50% is aero. Got it. So sir, we would be also bumping into our likes of a Tata Elxsi, L&T Tech also in auto?
Yeah. Yes. And so L&T is also a customer of ours, but they are also a competition in some cases.
Okay. And sir, in this auto and aero, this bulk of the revenue, do we work with the captive or do we work with Boeing, let's say for example, Boeing in captive in India, or do we work Boeing directly with the US counterpart?
So we work with both so where the group outsources to us, they also have Airbus and Dassault and others as customers. So we do work through the group for those customers, and we also work with the local companies. When we are calling out the local Airbus or Renault or Stellantis or any of those are part of our external revenue. Those are not part of the group numbers that we are talking about.
Thank you.
Okay. Thank you very much.
Thank you.
Thank you.
I request to all the participants kindly restrict to 2 questions per participant and join the queue again for a follow-up question. The next question is from the line of Rajesh Chaudhary from Zenith. Please go ahead.
Hello. Yeah. Good afternoon. My question would be like, see, our revenues have increased by, I think, close to 6% from the last year quarter to this year. But our expenses, and mainly the employee expenses, have gone by, I think, close to 16.5%. So will this trend continue in time to come, or can there be a check on that?
So the reason why we had our employee expenses going up is primarily similar to what I mentioned. We have a higher bench at this particular point of time, which we hired last year, from the calendar quarter Q3 onwards, in anticipation of opportunities and growth which we were expecting from the end of last year onwards, which didn't materialize. So we have started working on how to optimize this, and that's why I said that we'll probably have a better utilization rate and lesser bench ratio for next quarter onwards. And,
so because like 10% difference is not a difference.
I know.
Yeah.
We are acting on it, and that's the optimization effort that's going on. It started from February onwards, and we should start seeing the results from this quarter, but most of the results will be seen from next quarter on.
Mm-hmm. And did we have any forex loss this quarter? To my understanding, I think there is a loss of 5.6 here in the presentation that you have given. Is there any forex loss?
Ani, you want to take that?
Yes, I'll talk about it. Yeah, there is a forex loss in this quarter. So we have a forex loss of almost about 56 million in this quarter compared to
5.6. Yeah. Okay. Mm-hmm.
Yeah. We had the previous quarter. We had almost 94 million forex gain.
So this loss is primarily because we don't hedge our currency, or what?
Sorry, I didn't get your question.
We don't do any hedging in the currency.
Yes. So far we have not done any hedging, but we are looking at starting a hedging program going forward. We've also gotten principal approval from the board recently, so we'll be starting the hedging program to.
So we can expect that loss to be minimized or low loss in time to come.
Yeah, we should see some minimization in the coming quarters, and the hedging program will address it over a period of time. It's not going to immediately change the picture significantly, but we should definitely see some minimization in the risk.
Because in every year in 1 or 2 quarters we have been facing this issue. So I'm not sure why this has not been addressed earlier, but anyways.
That's because the forex movements are unpredictable, right? It's based on market conditions.
That's true. That is why we are doing a policy of hedging.
And just to clarify here, many of these losses are what we call it as almost 80% of these are notional because it's not converted as debt, but we have to do the mark to market every quarter, and that's the reason why this shows. Right now, it's not that all these money are converted into Indian rupees and we have incurred this loss.
That's right. Yeah. So again, just for perspective here, I want to clarify. So last year we had 107 million of forex gains. Okay.
Mm-hmm.
And even in the last year, same quarter, we had 12 million of forex gains. Previous quarter, we had 93 million of forex gains. It is only this quarter we had incurred a substantial loss of 56 million. So this is the first quarter where we had a substantial loss. Otherwise, we have always been, only in the game. So when we talk about, why this action has not been taken, it's the impact of that has been felt only in this quarter. So now we have acted and we have started, we have started a hedging program. So you should see the benefits coming in the future quarters.
Okay. And there is one more question. Last question is we have an aspiration of doubling our workforce by FY25. So are we still on track for that? And secondly, will that convert into doubling of revenues as well or no?
No, it's not likely to happen because we anticipated a substantial amount of business growth and we also anticipated some inorganic growth as well, which we thought is likely to happen in the last financial year and this financial year, which we don't see that happening at this particular point of time. But from a headcount to revenue perspective, yeah, ideally the headcount growth should double the revenue, but if the significant amount of the growth is going to come from the group which is on fixed markup, it may not exactly be that, but yeah, approximately it will be double the headcount. The revenue should also
the revenue should
almost double. Almost double, not exactly double, but almost double.
So this is on hold at the moment, or will this can be taken care in later part?
No, I don't see us. We talked about March 2026 to be 10,000 headcount. But given where we are right now, unless otherwise there is some significant market correction and growth that's going to come, I don't think we'll be able to achieve what we have set as our goal.
Thank you.
Okay, thank you. Thank you.
Thank you very much. I request all the participants kindly restrict to 2 questions per participant. Next question is on the line of Guneet Singh from Counter Cyclical PMS. Please go ahead.
Hi, sir. I want to understand the quarter-on-quarter headcount has gone down, but still the employee expenses have gone up by 6 to 7%. So what is the reason for that?
Mani, you want to take that?
Yeah. So, one of the reasons is because, we also had some wage increments coming in this quarter. So that's kind of taken our cost higher, though the headcount has not grown that much. The second reason is our proportion of on-site employees have gone up. So that's also kind of, taken our cost higher comparatively. Though on headcount basis, it's not that significant a growth, but on cost, costs have gone up.
On-site has been a movement from work from home to on-site.
No.
Offshore to
moving from India to
From India to, yes. Outside.
All right. Sir, and you mentioned that the demand scenario is likely to pick up, but right now it is still under pressure. But you also mentioned that you would not be significantly reducing the headcount, and that you will reduce the bench from about mid-teens to 10%. So, without significant demand, how do we see the bench reducing without any reduction in headcount? Can you throw some light on that?
We will reduce headcount. That's what I mentioned. So, when the bench will reduce with reduction in headcount. But most of the actions have already been taken. So right now, with the numbers that you see are people who are on notice as well. And as you know, in India, you need to have the 3 months minimum from the time you start taking action for the headcount to not show in your books. So,
and
most of the action will be taken, but the numbers will actually show only going forward.
Got it, sir. So, and lastly, you mentioned that we would be continuing with the current growth trend. So, we saw about an 8 to 10% increase in revenues in FY24. In terms of FY25, do we expect the revenues to be stable, or do we expect to maintain these levels? And on top of this, do we also expect similar kind of growth of about 8 to 10%?
We expect that we should be closer to double digits for this financial year. While the initial target was much higher than that. We expect that we should be closer to double digit growth for FY25.
All right, sir. So double digit growth with an improvement in EBITDA margins to 16-17%. All right, sir. Wish you all the best. Thank you very much.
Thank you. Next question is from the line of Rahil Shah from Crown Capital Partners. Please go ahead.
Yes, hi. No, I was just going to ask on the growth thing. So, what is stopping us at the moment from growing in mid-teens at least? And by when do you see us getting there? And what will be required to get us there? If you could just speak on that, please.
Sorry. So we, originally our plan was that we will probably be able to grow at 20-25%, and that's the basis with which we had the headcount when we started the year as well. However, the demand wasn't in line with that, and that's the reason why we are acting on optimizing our headcount as well. This year, we expect to be in that double digit, like what I mentioned, and hopefully by end of this year, once the demand starts picking up from the core markets, we should be in the teens or even better than that, closer to the 20% range, which hopefully should be seen in the next financial year.
So by first quarter next financial, you think you'll be able to start with the teens and 20% growth?
That's it.
And it's dependent on the market improvement.
Absolutely.
All right. And when you say EBITDA should be in the range of 16-17% over next 3 quarters, why do you just mention next 3 quarters, or do you expect for the full year? Or quarter four, it can be different, higher or lower?
So it depends. And once the demand picks up, in the first 2 quarters, we may have to invest in getting headcount and making sure that we are ready to capture the growth. So that's why we are watching every quarter. And the quarter where we see the demand picking up, we may probably have a little bit higher costs, but over a period of time, it should go back to the 15 to 17%.
But so still on an average, we can assume 16 at least for the year?
That's right.
Oh. All right. Okay. Thank you. All the best.
Thank you very much. Next follow-up question is from line of VP Rajesh from Banyan Capital Advisors. Please go ahead.
Hi. Thanks for the opportunity. Balaji, one question was just to understand what was the growth in this quarter for the group business versus the non-group business?
So in this quarter, the non-group business grew by around 4 to 5%, and the group business grew by around non-group business grew by around 3%, and the group business grew by a little over 5%.
I see. And in terms of the wage hike that Mani talked about, have we been always giving the wage hike in Q1, calendar Q4 fiscal year, or there was something special, which is why we did it in this particular quarter?
We actually postponed our wage increments by a quarter. Normally, it happens from January 1st onwards. This year, primarily because of the slowness in demand, and also we wanted to align with our budgeting process, we postponed it by a quarter.
So the number we are looking at is 156 crore of employee cost. This is without the wage hike, is it?
So part of the wage hikes were done in January, where we had already promised. And part of the wage hikes are actually effective from April 1st onwards.
I see. Okay. So this 156 crore of employee cost in the June quarter, do you think it will stabilize here, or will it go down because of the actions you have taken on the reduction of the workforce?
Mani, you want to take that?
Yes, I'll do that. So we expect this to slightly go down because in this quarter, there's a partial wage hike, and then there is also while we have taken action, the people still have approximately about 3 months notice. So the headcount has come down towards the end of the quarter, so that's why you see a headcount reduction. But from the cost perspective, the cost has been mostly there in this entire quarter. So you will see that going down in the subsequent quarters, as Balaji mentioned. But the other part of the wage hike will also come in, so that will kind of to some extent compensate. But overall, we still expect that we will continue to take action, so we should continue to see some reduction in this cost. Though it might not be substantial, there should be a marginal reduction to this cost. It shouldn't go up.
Got it. And just the last question on the revenue by industry. Our engineering business seem to be coming down. So anything in particular that you want to call out there?
So we have some challenges with the automotive industry. And particularly the reason was that if you recollect last quarter, we had one time which came from one of the customers. And last year also it was from the same customer where it was the work which was done there back in 2021 where we were billing the change requests or the increase. So that's the reason why there is a slight dip that you would see in the automotive specifically. But other than that, it's not coming down. Organically, it's not coming down.
I see. Okay. Thank you. That's all I have. All the best.
Thanks, Rajesh.
Thank you very much. Next question is from the line of Rohit from iThought PMS. Please go ahead.
The most questions have been answered. I was just trying to sort of further understand beyond CY24, how does one look at growth? I mean, that's the only question that I have. You're saying 10% this year, roughly, and as you said, that CY 25, 10,000 is not happening. Have we sort of revised our internal targets to something which is more achievable now, say, ICY 25 or something, and if you are willing to share that?
We haven't reworked on the numbers in terms of headcount, primarily because we are trying to also stabilize and make sure that we have a clearer view on what is going to come from the group and what is going to be done from the direct markets. But like what I mentioned, the expectation, even in this year, we thought that, once the core market picks up, we should probably be in the high teens or so, but that's not something which we are seeing at this particular point of time, but hopefully, before the Q4 calendar year, we should start seeing some growth. And that's why I think that next year, our ambition or our endeavor is to, be in the mid-teens to 20% plus range, which is what we did in 21 and 22, to go back to, those growth rates.
And just sort of related to this, I mean, it was asked earlier as well in the call. The price is so low, right? And what else? I mean, ideally, we shouldn't really be too much impacted by the market, I'm sure. I mean, any markets definitely impact the demand environment and etc. But given the base itself is so low, especially if you look at our direct business, is there something that we can do more to get at least better than the market growth, given that size is like not very high? So, I mean, is there something which is lacking or, yeah. So
we can find different reasons, but see, the challenge is also that when the market itself is slow, the bigger players are ready to throw in anything, to get even smaller engagements. Because normally you don't find the bigger players battling for 1 million and 2 million deals. But nowadays, everybody is there in the race for everything. So it is, it's a question of, how large the pie is and who is ready to, take what part of that particular pie. So, I agree with you that no, when we are small, you should be able to, technically what you're saying is right, but that's not what we are seeing in the market at this particular point of time. One is the customer's discretionary spend itself is lower, and wherever there is a spend, irrespective of the size of the deal, we are actually seeing bigger players playing in those opportunities as well. So it's a combination of multiple things. But having said that, that's the reason why we are at least seeing some amount of marginal growth from where we are.
right. And this last question on this. So let's say if growth picks up, whenever it picks up, whether it is direct or your group business, as you scale, right now we are at about $100 million, like more than $100 million, around $120 million. But let's say as you sort of get to more close to $200 million, is there any leverage or operating leverage benefits that you will have? And can the margins go beyond what you have indicated, or it is not going to be the case? How should one think about that?
I would say that, the margins, depending upon the mix, because as engineering business grows more and, the engineering margins are not as much as what the technology services margins are currently. We don't expect, that's why I've given the range of 16 to 18. I don't think it's going to change way beyond that.
And sure. That's helpful. Thank you very much. And I would really appreciate if you can have a clear thought process on the payout, because on your capital allocation, because markets typically would not like cash being, at least the thought process would be very appreciated. And we've been waiting for a very long time, Balaji. We waited for the merger to happen, and after merger also there is no clear thought process. So, really, as shareholders, you must we have at least some clarity. I would really appreciate it if something can come in the coming quarter.
Yeah, absolutely.
Thank you very much. As there are no further questions, I'll now hand the conference over to the management for closing comments.
Okay. Thanks, Nirav. Thank you for all the participants and the questions. Appreciate all your interest with us, and hopefully we should be back, with better results for next quarter. And looking forward to the same level of support. Mani, you want to add anything more?
I think we covered it, Balaji. So yeah, we are expecting to definitely have a better result next quarter. So we will come back with better numbers. Thank you. Thanks for that.
Thank you so much.
Thank you very much. On behalf of Expleo Solutions Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.
Thank you.